Hello, fellow traders. 'Tis I, the Rumpled One. It's September the 11th. The year's 2019. Wednesday. Let's talk trading. But let's take a moment to pause and remember what happened on September 11th, 2001. Okay, range matters, part 2. But before I get into the range part of it, I read an email this morning and I had to chuckle because it sounded like me talking to me. Um, the author was talking about his latest trip to Vegas, and he was sitting at the 21 table, a blackjack table, and he was doing something that I do. When I play blackjack, I never hit if I have 12 or more. Never. Why? It's real simple. If I lose, I can't win. And he was saying how this one lady who was losing like hundreds of dollars, like, every few minutes, was getting mad at him, saying he doesn't know, this guy here doesn't know how to play. But, this guy who wouldn't, who would stand on 12 or more was actually winning. And she's like, you got to take your hits like the rest of us. She's just getting all mad. She was talking to the dealer, and the dealer's, yeah, this guy doesn't know how to play. But what he pointed out was, number one, don't listen to other people. Do your thing, especially if it's working for you. And number two, if you go into the gift shops or little stands that they have there at the casinos, they'll sell you books on blackjack strategy. And it should be obvious to the reader or the person that these strategies don't work. Because if the strategies did work, number one, the casinos wouldn't sell them. And number two, if you use these strategies, they would throw you out of the casino. I mean, counting cards works. That's why if you're caught counting, you get barred from the casino, and you might even be barred from all the casinos once they start, telling their buddies what you look like. It's that simple. So in trading, if you think about it, there's these people out there telling you how to set up your charts and what indicators to use. And this is what I call the traditional trading education. Doesn't work. Because if it worked, there would probably be no market. Because if 9% of traders won, I mean, how could they win if everybody's doing the same? It just doesn't make any sense. Not to mention, these brokers that always win, they invite you to their various websites and platforms and subscriptions, and they'll tell you how to trade. But once again, 99% of them lose. And what is it? 95% of the world's best money managers can't beat the index. They just can't beat the market. So it kind of goes without saying, don't follow the crowd. So what's that got to do with trading? Everything. Everything. One thing though, you have to always use risk and money management no matter what system you employ, because you cannot afford to lose more than you're willing to lose per trade. So, range, average true range, average range. There's, they talk about range. Thing is, they really don't analyze it like I do. They don't employ it the way I do. They only tell you, they just tell you, okay, use ATR 14 or ATR 12, and, that's just it. They really don't go into the depth of it. And if they do, it's on a conceptual basis rather than a reality basis. And so, as if you're new and to watching my videos, and you've Googled the TheRumpledOne, you see all kinds of people running me down and telling me I'm a scam artist and this one. Number one, the only thing I sell are Drain the Bank's t-shirts. And number two, you know, my systems, you can look at the frequency distributions, the statistical analysis, and you can see that they're true. Of course, your results may be different from mine because these videos are for educational purposes only. And you have to remember, trading is risky, forex trading is risky, and if you really want to seek advice, you should seek it from an accredited financial professional rather than some Yahoo on YouTube, right? Because that way, when you lose, you know your money was lost by the best. And hey, well, if they lose it, I mean, they're better than you, so you couldn't do any better, right? Of course you can. So let's look at it. Weekly here, all the gaps filled. You can see we broke out of the previous week's upper wick zone. We're up by 52 pips. Oh, this is such a no-brainer, right? And here we're now only 190 pips below the open of the year for the yen. We're 330 above. Now, why is it that I will just show you examples of one pair per month for the whole month? Why do I do that? Well, see, that way I can't get accused of cherry picking. Okay, because a lot of people will come, oh, well, he's just cherry picking trades and blah, blah, blah. No, I'm showing you the same pair, 4 weeks in a row. 20, 21, 22 trading days in a row. How could that be cherry picking? Especially last time somebody even picked a pair for me. So, I mean, that's why you can't listen to other people. They're just making noise. On the daily, okay, we broke out of the previous day's upper wick zone, that previous day's high up by 17, off today's high by 10. So that was 27 pip potential if you nailed it at the top. I mean, once again, simple trades, only 3 pairs with range over 100 today, and the yen coming in at 36. That's really pathetic, right? Okay, back. Let's get into range a little bit more. I added the 2019 frequency distribution here. Now, it's basically giving you the same information, except this is cumulative. So you see how many were over for the day, how many ranges over 100, how many over 10, how many over 20, how many over 30. It gives it to you in a percentage and in numbers. So you can see here, high minus low, that's the range, over 109%. On this one, 9%. But here, how many over 90? It was a total of 13. 9 and 4 is 13, and so on. So what's that mean? Okay, once range gets past 50, you can see it being more than 60. It's only going to happen 44% at a time. More than 70, 27%. How does that help you? Well, I get questions. When do I take profit? Well, let's just say if the average, if the daily range is above 50 on dollar yen, you might want to think about taking profit. That should be obvious, right? Because if it's between 50 and 60, chances of it going past 60, it's only what? About 2 out of 5. So 4 out of 10, 44 out of 100. Do you want to take those chances? You could. Then 70, you're really pushing it, right? So that's how you can use this knowledge. So, you run these frequency distributions, only probably have to run them like at the beginning of the week, or you can look at them every day just to see, but they're not going to change month for each day. And I just use the last 100 days. But you can use the last 1,000 or 5,000, how, the numbers really don't change too much. Point being is This is how you can determine when to take profit, because the market's not static. Okay, it's dynamic, it's moving all the time. So because of that, you need to be able to make your decisions in real time. Now, of course, you can put your TP here and hope it hits, but if you're going to sit in front of the screen, you can definitely be dynamic. So range happens from high minus low, but to get to the high, price has to go from the open to the high, and to get to the low, price has to go from open to the low. That's simple, right? Once again, we've got 20 pips. Open plus 10, open minus 10, that's 20 pip range. What's the chances of the yen's range being greater than 20? 99%. Therefore, if you trade inside this range, chance of price going outside it is like 99 out of 100. This is what you call a lock. Okay, so right here, even though pivot point was below, but we're going to ignore that for range. Price gets here, plus 10. It has to range, so it's either going to continue up here or it's going to reverse and come outside the zone here, at which time you either stop out at the open or stop and reverse at the short zone. This is just really simple stuff. Okay? And that's, once again, how we're using range. Now, think about something. The open is usually near the previous day's close, right? So, knowing that, see, this is the open, there's the close. You see that? What's that? That's the upper wick zone. There's the high right there. Let me expand that. Okay, there's the high, there's the candle top. So this is the upper wick zone. So, using the price travel analyzer, open less than previous high, check. High greater than previous high. Yeah, it happened 45% of the time, right? Now, how many times does the close greater than the previous high? 18 out of 45, or 40% of the time. What's that tell you? When price gets up here, there's a good possibility that it could come back below here. So if you see price, like in this case, nearing this previous high, which it didn't, it's time to start taking profit. Okay, so sometimes it goes up and comes back down, for example right here. So what does this tell you? You see price went up above the previous high, came back down. So it gets here, you got a 40% chance of it closing higher. So take your profit. Otherwise, look what happened. That's how you analyze the price. But see, price opened here, it needs to range. So it ranged right out of that wick zone. See, price has to range. We've seen that. Rat zone, once again, not enough pips to trade the rat zone. Once here, we want to see price ranging, but we know H1, there's just not enough pips per H1. But maybe if you shift up to H4, and as we wait for the H4 chart to load, I'm going to pause the video. Okay, you can see here at H4 for the dollar yen, there's not too many candles that open and stay between these lines. Why? Range. And here again, I just opened this trading profile so you can see here we're right back to where we started, but it didn't stay within this. See, it broke out, but then it came back. That happens. And showing the average trading range here, you see the blue, that is the weekly, but we're getting closer to that weekly ATR, the minimum ATR, which was ATR 2, the max being ATR 7. So, fellow traders, that's part 2 of range. Just remember, it's not what you trade, it's how you trade it. So go out there, drain the banks. Don't listen to what other people say.